Of course, we're talking about geopolitical tensions around North Korea. We do have the RBA rate decision today. What are the key drivers for the markets in the short term for you?
I think in the short term, we're still neutral on equities, on U.S. equities, global equities. We are maintaining caution in the markets. I think in the key drivers in the next 3 or 4 months is just staying cautious and seeing where inflation numbers are going to be, if the job markets are still going to be this strong, because the Fed has long stressed that any type of rate movements or rate hikes is going to be dependent on inflation and the job market. So we're going to be sitting pretty close to the sidelines and just kind of seeing where those numbers are going to be.
The appeal of global stocks as measured by dividend yields over treasury yields, for example, this chart on the Bloomberg shows, has really turned negative and is at 11-year low. Is that why you're more neutral when it comes to global equities?
Yes, certainly. I mean, that's one of the reasons. And also, there's just a lot of uncertainty going on, still going towards this end of this year, not just the Fed, but also, I mean, a lot of it's going to be driven by the Fed and where rates are going to be, but also the geopolitical tensions, Ukraine, that's, causing a lot of volatility in the commodity markets, in various markets, the recession that's going to happen in Europe and UK. China is also not coming back as fast as we are hoping. So, I mean, there's just a lot of uncertainty out there. So we are very neutral on equities at this point and not rushing getting into the markets.
Do we set ourselves up for further disappointment going into earnings? Because there still seems to be a great deal of uncertainty when it comes to guidance.
Yes, that's a very good point. I mean, we definitely expect weaker Q3 earnings. The risk of credit markets cracking is rising as primary market volumes collapse. So, I mean, we also see a lot of volatility coming for emerging market equities. Those earnings are not going to be as good as well. So, with that said, again, that's the reason why we are still very neutral on equities.
What does your strategy look like if you're neutral on equities, if there's a great deal of a lack of clarity, if you will, going into the coming months? What is the catalyst to become more confident?
That's a great question. I mean, right now we are maintaining our market position. If clients are invested in the markets, we have been actually trimming down on growth and tech all year long, and we're staying invested. We're not cashing out of the markets, but if there's any cash on the sidelines, we are not going into the markets either. Treasury yields on the lower end are very high, and so we are basically going to focus more on value, more on energy, more on healthcare, and I think as the markets get a little bit better, when we can have more stable inflation numbers, seeing those numbers cool down, better jobs situation in the U.S., and the Fed can finally maybe see some of the hikes, or at least eventually rate starts coming back down a little bit, that's when we can feel more comfortable of going back into the markets if there is any cash on the sidelines.
One of the key drivers could potentially be what we get if we get some policy outcome from the Party Congress. Do you have any expectations or wish list on what we might see?
I mean, of course, we hope that there's going to be more, we hope there's going to be more certainty on the policy. But, this is all very, it's very uncertain out there. So we hope that, with probably hopefully with better inflation numbers, better job numbers, we would see less hikes and the markets and earnings can get more back in track, and then we can get back into the equity markets.
And we also saw a U-turn when it came to the UK government and a little bit of support for sterling, given that they're scrapping some of those tax cuts. What are you expecting in terms of the economy in the UK and Europe and the implications for Asian markets?
Yeah, I think the UK and also Eurozone is in a, it's probably going into a recession in the next 6 or 12 months. And also with the Ukraine war, that's still ongoing, and we don't see any stability in that area right now. That's going to cause a lot of volatility in the commodity markets and in energy markets as well. Asia, if Asia right now, China, the recovery is a lot slower than we anticipated. If somehow, as China comes out of this pandemic, and if the economy can pick up in China, that might be a good way, a good situation for some of the developed markets. Hopefully, that will lead a little bit of growth back into the global economy.
Is there a way to play the volatility in the commodity space that you talk about?
I mean, certainly. I mean, commodities is in the near term, it's going to be very volatile, but it's just high in demand. There's a shortage of supply right now. So probably in the near term, still volatile. But if you're going to get into commodities, it's probably going to be a longer term play. Again, we still want to focus on the overall diversified portfolio and not in any one sector at this point, and mainly stay pretty cautious, focusing more on value, more quality, and remain invested in the markets until there's more dependent data that we can see and see that the macroeconomy it's going to get better.